So there are 4 different types of financing that lenders can offer your clients. The most common ones are going to be conventional, FHA, and VA. Now there is a 4th one, which is USDA, the U.S. Department of Agriculture. That one is a little trickier and a little harder for your clients to qualify for. They're for more rural areas, but I'll get more into that here in just a little bit. But when you're conventional, you'll also hear some people refer to those as Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac are the ones that insure conventional loans. So if they say Fannie or Freddie or something along those lines, they're referring to conventional loans. FHA, Federal Housing Administration, VA, obviously for veterans, and USDA is basically like an FHA loan, but for rural housing. So now there's different type of criteria that you have to qualify for with these different ones. So I'll go over each one of them individually. Now, typically with a down payment with conventional, and conventional is going to be the most common one that you want to have your borrowers try to qualify for if they're not a veteran, obviously. With conventional, as a first-time home buyer, they can put down as little as 3%. So 3% is the minimum down payment for a conventional loan as a first-time home buyer. Now, when I say first-time home buyer, typically people think that they have to never have owned a home ever in their life before. That's actually not true. A borrower can be a first-time home buyer if they've not owned a home within the last 3 years or greater. So as long as they haven't owned a home for 3 years or greater, they are also considered a first-time home buyer and can put down 3%. Now, 3% is going to get them into the house, but the pricing and the interest rate and whatnot is probably not going to be as favorable. Typically, 5% is the minimum that you want to have them put down if they're able to do so, because they get better financing, better pricing, and it's better for them all around. But they can get away with 3% if they're a first-time home buyer, and obviously, if they're not a first-time home buyer, 5% is the minimum that they have to put down. FHA loans. FHA loans minimum 3.5%. 3.5% down is what an FHA loan requires for you to put down to get into a house with them. VA, if you're a veteran, you don't have to put anything down. 0 down payment required whatsoever, which is fantastic. And the same thing for USDA. USDA, you can actually put 0% down for USDA. However, I'm going to go into some of the intricacies of USDA right now. So with a USDA loan, like I told you before, they're for more rural areas and more rural housing areas geographically. So geographically, they have to be in what's considered a rural area. And when I say that, I mean, they have to have a population of 35,000 people or less. So 35,000 people in the area or less. And also the income for a 1 to 4 person household has to be $91,900 or less. And for 5 or greater people in the household, $121,300 is the cap of income. Now, when I say income, I don't mean just the adults. If you have a 15 or 16-year-old daughter or son that's working at a movie theater or at a restaurant as a server or busboy, they count that income in there as well. They count every single source of income into that qualification. So it gets really, really tricky. So that's why, USDA is available. If someone, knows about it, inquires about it, they qualify. If they can, it's great because once again, they don't have to put any money down, and it's just like an FHA loan, but it's a little harder to get into than most people think. So
you say population, or saying population of the city or
of the city, correct? Of the city, yeah. The population of the city has to be 35,000 or less people in the city. Yeah.
Now I know.
Yeah, there's a lot of quirky things with USDA.
So that's good, because when I'm looking at creating my listings, I don't know what to put as available financing as far as USDA.
Correct.
And I usually don't, because I have no idea. Now I know.
Exactly.
So I know if I'm listing in a town that has 35,000 or less, I can put USDA as an option.
That's correct. So if you're actually going to be in an area like Jennifer said, in an area that's more rural and it has a lower population, that could be an option for somebody, which is another added thing that a lot of lenders don't even know about. They don't ever really do. Personally, I haven't done a ton of those. I've probably done maybe 20 to 30 in my entire career, because it's like a niche product, but it's very powerful if you have the ability and you know about it. So now you know about it. All right, now with your borrowers, there's different kinds of PMI that come along with their loans if they put down the minimum payments that we just spoke about. So the PMI on a conventional, and this is what I found that a lot of realtors ask me, and they're not really too versed on, but it's actually good to know, because if your client asks you about this, it's very, very good to know about this. So PMI on a conventional loan is 80% or less of the loan to value ratio. So if they're putting down less than 20% of a down payment, PMI is going to be on there no matter what. Now, there are ways that if you put down less, like 15 or 10%, you can do what's called LPMI, lender paid mortgage insurance, which means they pay a lump sum up front instead of over the life of the loan every single month, and they get rid of it. And it actually does save them money, but I'm not going to get into the nitty gritty with you guys here. So just know 20% or less, typically PMI unconventional. FHA, if you put down less than 10% on an FHA loan, the PMI stays on there for the entire life of the loan, never goes away. The only way you can get rid of it is if you refinance or if you sell the house. Otherwise, it's on there forever. Now, if you put down more than 10% on an FHA loan, it's still on there for 11 years, which is a long time. So even with
between 10 and 20%.
Even if they put 50% down, it's still, PMI is on FHA no matter what. Even if you put, 50, 60, 70% down, you still have it on there for the entire life of the loan. So, or I'm sorry, for 11 years, excuse me, when you do it that way. So 11 years, it's on there no matter what. VA, there is no mortgage insurance no matter what. So not only do the veterans get 0% down financing, they also don't pay any PMI at all, no matter what, which is fantastic. It's, in my opinion, the best loan product on the planet right now. So if you have a veteran, it's a very, very strong program to offer them. A lot of lenders don't really know a lot about them. I do. I was on a VA team for 4 years where I dealt with only veterans, so very well versed in that. The only downside with a VA loan is the fact that they have what's called the VA funding fee, which means if they are a veteran and they are not receiving VA disability benefits, they have to pay a certain percentage to the VA, which is a lump sum amount that's rolled into the loan. They don't pay it out of pocket, but it's rolled into the loan. But if they are receiving VA disability benefits, they waive that completely. There is none. So that's the thing with VA. USDA, going back to the PMI, the USDA, they have, just like FHA, they have the mortgage insurance or the PMI for the life of the loan, no matter what, whether you put down 5%, 10%, no matter what. But the only difference is that decreases over time as the loan amount decreases, and it'll eventually go down to zero once they pay it off. So, but it goes down dramatically. Now, the part that's actually going to be interesting and applicable to you as a realtor, excuse me, is when it comes down to the appraisals and the appraisal types for these types of financing. So as far as the appraisals go, now, one of the things that deters a lot of realtors from going with FHA and VA is that their appraisals are a little more, they kind of nitpick a little more with their appraisals. FHA nitpicks a little bit more than conventional, and VA nitpicks more than FHA, which is more than conventional. So they look at chipped or peeling paint. So if there's any chipped or peeling paint around a window or on a garage, they have to go out there and scrape it, repaint it. They'll make them do that kind of stuff. They look at, the house has to be basically turnkey, move-in ready. And that's it. We're not talking about, paint color not being, the right color, or, something not being updated, but if it's, around those lines, they make sure that it needs to be done before they'll sign off on it. Conventional is not that way. Conventional is a little more lenient with their appraisals. They'll come out and they'll say, hey, listen, as long as there's no major issues, health or safety issues, there aren't any holes in the roof, or there's a leak in there, or anything in the siding of the house, or any holes in the walls, nothing like that, nothing crazy, they're okay with it. They're totally fine. Once again, FHA and VA a little bit different. Same thing with the USDA. They're more picky with their appraisals, and that's where it can kind of get into, you as a realtor, it'll make your job a little more difficult sometimes, depending on the appraiser, but they can be a little more nitpicky when it comes to FHA and VA appraisals.
So that's not just explaining to your buyers, also
Correct.
Explaining to your seller.
Correct.
That, hey, when we start getting offers, here's the expectation you need to have.
Mm-hmm.
When an FHA buyer is purchasing your house, have have to set that expectation. You may have some minor repairs
Correct.
you have to do.
Yeah, and typically the seller and the sellers, the listing realtor will know about that as well ahead of time. And that would, I mean, obviously you're gonna be a listing realtor as well, so you need to know about this stuff, because when you get these offers in, you're gonna need to know what to look for your seller as well. So hey, say, hey, listen, we have this FHA offer, or we have this VA offer. So obviously know that, this is what's gonna come along with it. The appraisal is gonna be a little more nitpicky. We gotta make sure the house is a little more, put together and kind of tighten it up a little bit. So just be aware of that when it comes down to appraisals. And I hope that
Yes.
kind of answers your question there. So also credit scores, obviously with conventional, anybody that has a 680 or higher credit score is typically going to go conventional financing. So 680 and higher is going to be your conventional buyers. Anything below 680, especially below 660 credit score, that's going to be your FHA buyers, which is why FHA, whenever you receive an FHA offer, or whenever you have a buyer that goes FHA, they know that either their credit's a little bit beat up or something. They're not as strong as a buyer as a conventional buyer, because that's the reason why they're going FHA. VA is just, I mean, they can have good credit, bad credit, it doesn't matter. As long as they have a 620 or higher, they can go VA, and the pricing is the same pretty much throughout. So the VA is a really good loan. They back everybody up. USDA is more along the lines of FHA, to where it can be, usually the lower end of the scale as far as the credit goes. But that's kind of where you're looking at now. 620 is our minimum at Keller Mortgage, and a lot of lenders out there, their minimum credit scores are 620. You can find lenders that will go down to 580, but there's a lot of different factors that they add on to there, a lot of different risk layering factors and criteria that they make them qualify for. And also their pricing is going to reflect that as well. They definitely have a higher rate and higher costs and whatnot. So you can get them into a house with a 580. Just let them know if their credit score is below 620, between 580 and 620, they're gonna jump through some hoops, and their pricing is not going to be that great. So, but once again, here at Keller Mortgage, 620 and higher, we can go any product out there, no matter what whatsoever. And now we're going to go into closing costs. So closing costs, one of the shameless plug here for myself and Keller Mortgage, one of the benefits of utilizing myself and Keller Mortgage, your in-house lender here at Keller Williams, is we have no closing costs. So our lender fees are zero for all of your clients. And on top of that, anybody that's looking to buy one of your listings, they qualify for it as well. So it's a good selling feature. So they don't even have to be working with you. As they're buying your house, you can say, hey, listen, I can save you a lot of money on your financing, get you in here even better. And somebody will buy your house, faster than they'll buy another one, because they can save a ton of money. So we have no closing costs whatsoever. But with the conventional financing, you're going to typically have with, any other lender out there, typically have like a processing fee, an underwriting fee, an origination fee, whatever that may be. Typically that's going to be around, a couple thousand to, $2,000 to $5,000 in some cases. FHA, it's going to be a little bit higher, because they have what's called the upfront mortgage insurance premium, which is the FHA's fee right off the bat. So FHA has a fee not only to do the loan through them, which is a certain percentage of the loan amount, but they also pay mortgage insurance on top of that for, once again, either the life of the loan or 11 years minimum. So it's a little more expensive, but they let you get into the house if your credit score is a little bit on the lower end of the scale. So the upfront mortgage insurance premium with FHA, plus the, whatever the lender fees are, or with us, zero. VA, you're going to have the VA funding fee, which I already spoke about, which is the fee to the VA that can be waived if the veteran is receiving VA disability benefits. If they're not, then they have to pay the funding fee, which is, once again, a certain percentage of the loan amount. And once again, not getting into, I don't want to get into all the nitty gritties of everything and get everybody confused here, but if the veteran does put down, instead of 0%, if they do put down a certain percentage as a down payment, the VA funding fee decreases. So there is a benefit to them if they do put down some money as a down payment instead of zero. All right, and USDA, same thing. They have an upfront mortgage insurance premium, just like FHA. A little pricier, but they let you get in, and the terms are usually a little bit better than some. So I think that's pretty much covers the meat and potatoes of everything that we have. We have the types of financing, went over the different down payments, the PMI for each one, the appraisals, obviously, which is going to be huge for you. So you know what to look for whenever you get these offers in. Sure. Question.
I have a question.
Sure, go for it.
That's so fantastic that there's no closing cost with your mortgage. If you get a listing, is it anything the company would frown on if you added that to your comments? Finance with Keller Mortgage, no closing cost?
No, I mean, I would
Can
say,
we put it in?
I wouldn't say no closing costs because there are
Oh.
third-party title fees that we have no control over as a lender. No lender has control over, such as, just,
Okay,
the title insurance and all that kind of stuff that the title company is
Yeah.
going to charge. So we don't cover all of that, but we have no lender fees. But yes, you can say
okay.
zero
So as
lender,
long as that's correctly worded, no lender fee.
zero lender fees, which is going to save them thousands upfront. And another thing, if the loan amount is over $150,000, we also give them an additional $1,000 credit on top of that. So not only are there zero fees, we give them an extra $1,000 credit. So we're basically paying them $1,000 to do the loan through us if their loan amount's over 150.
Wow, makes me want to refinance my house.
You would be amazed at how many realtors have refinanced through me. Yeah, they
That's
usually,
good.
yeah. So
Thank you.
yeah, it's fantastic. And our rates are lower than most out there, if not all as well on top of that. So they're getting a really low rate, no fees, extra $1,000 credit. I mean, they're saving money all around. It's amazing.
How much are the rates right now for a conventional loan with a really good down payment?
With I mean, at least like a 5% down payment. I mean, I'm locking in rates right now at at par, 2.875 or 2.75 with no buy down, no fees, extra $1,000 credit. I mean, the rates they're actually pretty good right now. They were higher like a month ago plus, but they're actually not even, maybe just a few weeks ago, they were even higher than they are right now. They've come down.
Yeah, I know.
They're pretty good.
Thank you so much.
Yeah, no problem. And if you have any other, I'm going to give you guys my contact information as well. Obviously, you know that I'm in the Elevate office, second floor. If you ever want to come in and just pop in and say hello, I'm here. But my contact information, if you want to call or text me, it's 440-668-2942. That's my direct line. Or you can email me at Sheffey, which is my last name, SHEFFEY @kellermortgage.com. You can reach me either one of those ways, or you can just come see me.
Everybody get that?
Yeah, do you need me to repeat that at all? Anybody? 440-668-2942. You can call or text me there. My email address is M for Matthew and Sheffey, SHEFFEY @kellermortgage.com. And you can call me Matt, by the way. You don't have to call me Matthew. Only my wife is mad at me, calls me that. Okay. So I'm going to open it up to anybody. Does anybody have any questions on anything that we went over here, anything that we spoke about, or just in general, lending questions in general, anything? I'm an open book here. No, nothing.
They have a lot to chew on there.
Yeah, I know. I kind of threw a lot at you. I hope I didn't overwhelm you at all, but if you need any refreshers on any of this stuff, if you have any questions about this at all, you just want to, shoot me a message or an email, feel free to do so. I'm always here. So just reach out to me if you need me. And I hope to be working with you guys soon. Welcome.
Thank you very much.
Back over to Jennifer. Thanks, guys.
Thank you, Matt.
Of course.
That was awesome. I learn every time too. I'm always learning. So thank you guys for showing up today. We'll put this recording out there for those who couldn't make it. Who's going to work on their 8x8 with some of those leads in productivity coaching today? Yes. Thank you, Jalissa. Anybody else? Mia, do you have access yet on there on Keller, on our command?
I have to check that.
Okay, and I will double check it as well. And then call me if you have any issues with that. It's a great way to practice and see, what you can come up with and setting up those 8x8s. And just if I've already sent like a text or something to them, just ignore that and just take it over. So, all right, guys, have fun doing your lead gen today, making calls, maybe some script practice, and I will see you on Monday. Have a great weekend.
You too. Bye-bye.
Bye.